What is up everybody, my name is Yasin and you are watching The Passionate Realtor. Last week I came across a research paper that was published by BIS and BIS is basically means Bank of International Settlements, so they call themselves Bank of Central Banks. What they really do is they actually provide assistance and support to central banks of different countries with regards to analytics data that they are collecting and then the research that they're putting out there in order to help them to define their policy for the next coming years. This article was very interesting because even though it was published back in 2018, but it still has a lot of relevance in today's market dynamics. What they've done is they have published a paper based upon 5 key indicators. They call them early warning indicators, and according to them, if a economy or a country trigger one of those or at least 2 of those 5 major indicators, that means they're running into a big financial crisis, a potential financial crisis 3 years down the road. And they're not talking about a local small level financial crisis. They're talking about a global systematic financial crisis which may spill over to other national economies and could become a global event, just like GFC back in 2008 and 2009. So what they've done is they published this paper and they collected the data from different sources, right? Central banks, from different countries, IMF, WEF, OECD. So all of these, institutes, they collected the data from them and they put together this data and analyze, okay, what significance it is going to bring if we consider the data, relative to their national trend. And they backtrack it and then they saw, okay, back in the 80s and 90s and 2007 and 8, when we had those financial crises, how much relevance those triggers brought if we look into that perspective. So it's very interesting, and what they have done is they published this chart that I'm sharing on my screen. You can see they have 4 columns, and these 4 columns are basically representing the key parameters or early warning indicators. And there's one which is missing, which is basically property pricing. And the way they used property pricing is basically to combine with or merge with one of these key indicators to show them the relevance in terms of, if you combine this with property price acquisition, what does it mean? So let me explain. So it's a little bit, complex, busy chart, but stay with me. I will try my best to explain to you. The number 1 parameter is credit to GDP gap. And what it means is basically how much credit a typical institute, whether this is household or private or public organization, basically non-financial or non-banking sector, how much credit they're taking relative to their GDP trend. Now, if their trend, is crazy, then if they're going ahead, well ahead of themselves, like they're getting even more crazier, then it becomes a red flag that they're going against their national trend, right? Basically 3 years. And that's what, the credit to GDP gap shows. The next indicator is debt to service ratio. Now, this is basically a total debt across the nation. That means household, private entities, private corporations, public organizations, how much debt they have taken and how much earning is being spent in terms of servicing that debt with regards to interest payments and principal amortization. So DSR basically tells you how much earning or income being spent to service the debt they have taken. The third one is household DSR. Now the second is basically the combined DSR. The third is household DSR, means you and I, a common person, what percentage of our income is being spent to service that debt. So that's basically in the context of a common household. The fourth is cross-border claims. So cross-border claims, they have measured with relative to GDP. Okay, so how much international money is being coming into or flown into a major economy, and then compare this with the GDP trend, right? Okay, if again this is aligned with the GDP growth, then it's okay. But if it is going way above the GDP trend line, that means it's a major flag, red flag that we can assess that why a lot of fund being flown into the country, but it's not producing any contribution into the GDP growth. So these are the four early morning indicators that they have assessed. And as I said, there is a fifth one, which is property prices. They have not specifically spelled it out here, but the property prices are actually measured along with these individual indicators. So if you look at the chart, you can see some countries have asterisk next to their number. It means that, for example, credit to GDP growth is actually measured along with the property price appreciation. So asterisk means you have property prices combined with this indicator. So you can see there are two different colors, right? The amber color or yellow or red color, right? So amber is where you are kind of in the high watermark zone, but you have not gone too crazy yet, right? So that's what the amber and yellow category denotes. The red is you are way out of your ahead of your game, right? So that means you are in the red zone. You have triggered that threshold limit, and you are in the category where your economy can trigger into, or your economy can run into a major financial or banking crisis. As you can see, Canada is the only country which has triggered all four of those early warning indicators. Two of them in yellow zone, which are cross-border claims to GDP and household DSR, and the rest of the two are red, which is credit to GDP gap and debt service ratio at a national level. Now, think about that. This data or this article is published back in 2018. How much we Canadians have gone ahead of ourselves in the last 3 years. That is crazy. Like, we have seen the debt to GDP ratio has gone up like 113% last I checked, which is way ahead the benchmark. The DSR ratio has gone also overblown, both at the national level and at also the household level. So when I looked at this chart and I was thinking, okay, this was published in 2018. How much worse condition we are in now in 2021, right? So you can imagine, what I'm alluding towards. So the purpose of sharing this information with you is to let you know that the economic condition is far worse than we are thinking in terms of the GDP growth and the recovery, because there's so much debt has been taken across the board, both at corporate level, at federal level, and also at the household level. There's too much credit has been issued compared to the GDP growth. GDP has been almost flat, to be honest. And the cross-border claim is also very high because we have too much money coming in from external countries, and that is not producing any GDP contribution, right? That is being spent into real estate. And real estate is a non-performing asset. It doesn't produce any goods and services in the economy. So that's a very negative sign, to be honest. And when I looked at this and I think about, okay, can Bank of Canada really increase the interest rate given the situation is that bad? I to be honest, I struggle to find this answer, because even they increased the interest rate from 0.25 to, let's say, 0.5 or 0.75, you can imagine how much insolvencies we will potentially see across the board, both at corporate and national level, as well as at individual level, because we Canadians have taken too much debt. We have taken we have leveraged ourselves way out of ourselves. So we are very vulnerable in terms of any potential banking or financial crisis. If the interest rate goes up, or if, God forbid, anything happens that spills over from the external world, we are right at the edge, right? If something goes wrong financially or in banking sector, even outside of Canada, maybe in China, Evergrande situation, or in US, we will be pushed further down the road big time. So I just wanted to share with you so that you can make your decision wisely with regards to your investment or saving your wealth. Please put your comments down below. What do you think about this? Ask me any question. Maybe I have missed something, so point me to any of those points. If I missed any of those, I would like to hear from you. What do you think about that? And until my next video, take care.